Alright, I'm gonna do a hidden monkey golden gecko tutorial real quick on how to monitor and manage your positions. And some of the things I use a lot are right here. If you go to golden gecko thread, which is my favorite slides, I think it's really important you folks understand why I use these and what they're about. Okay, this first one there's a mega strangle study. It just goes to show you how strong just being non-directional can be. Um, this one right here, selective entry ETS, this is just showing you that if you look at an ETF with their IB rank above 50 and you collect at least 19.8% of the expected move, look at your percentage winners. Okay, you have a 93% win rate. All right. Um, in this same slide, you'll see here, um, since there was a 64% occurrence, they wanted to use 35% IB rank because you get more, more occurrences to trade. And here are the results here. That third slide over. So if you do a golden gecko, you collect at least 19.8% of the expected move when you price it out as a strangle, and IB rank is at least above 35, you still had an 84% win rate. Okay, and you had more occurrences. So now you know why that's my cheat sheet or what I go over. Now, once you're in a trade, this next one right here is pretty neat. The outer slides are from the market manager, and I created my own right here. But basically, if you want to know when you should take your profits, okay, here's what you can look at. I made this one right here. I don't know if I can move this over real quick, but yeah, it's cut off a little bit at the end, but this is percentage of max profit, assuming you traded something 45 days to expiration, right? Percentage of max profit, average days you've held it, but I added this third column where it says average days left. Why? Because when you're looking at your positions like VXX right here, and you open it up, you'll see that there's 28 days left. Okay, so the market measure, the way they did it was they looked at it by how many days into the trade. So assuming you start at 45 days, you're 3 days into the trade. This is how you read this. Well, 45 minus 3 is 42, so that you should say 42 days left on the trade. Now, if you have 42 days left on the trade and you already hit 10% of your max profit, that means you're right on track. But you might want to already take profits. So, for example, let's say you're only 6 days into the trade and you put it on 45 days expiration and you have 35 days left and you're already at, let's say, 50% of max profit. Take it, because according to this, you're way ahead of schedule. You should only have 30% of your max profit. Okay, so I print this out, I leave it up, and I look. So if I have a position on and I have 39 days left right here and I'm already over 25% of max profit, take it, close it, take your profits and run. So that's one where you can use that. These other two time frames on here, one is for I think 30 and 60 days. So you can print those out and use them as well. And now this next one up here is pretty important, because let's say the SPY is not above 50% or not above 35%, and you're looking for something to trade. Okay, volatility adjusted strikes. Take a look what they did on the SPY from 2009 to present. They did a golden gecko, or basically a 1 standard deviation strangle, a 1.5, and a 2 standard deviation strangle. But what they did was, if the SPX was between 0 and 24 in IB rank, they did a 2 standard deviation strangle. There were 42 occurrences when that happened. If IB rank was between 25 and 49, they did a 1.5 standard deviation strangle, which is about 91% out of the money. Okay, 2 standard deviation is about 98% out of the money. 1.5 is about 91. And of course, 50 plus, they did a 1 standard deviation strangle, which is, like I said, about 84% out of the money on both sides. Okay, and these were the results. So as you can see, when you if you always did a 1 standard deviation triangle, here's all, and you always did a 1.5, and you always did a 2 standard deviation triangle, here were your results. Okay, percentage of wins, I guess, 77, 92, 100. But if you use the adjusted strategy, meaning, and you used these positions depending on where IV rank was. So if you followed basically this chart, and let's say right now IV ranks between 25 and 49, so you would sell a 91% golden gecko or 1.5 standard deviation triangle. When you combine and you only did that, I'm sorry, and you follow that chart, here was your adjusted return. You had a 97% win rate. Okay, your biggest loss was for negative 45 compared to negative 9, and your percentage of wins 97%. You had the same number of occurrences. You were just trading, moving your strikes out depending on where IV rank was, and these are all one lots. And your average return on capital was 1.9%, I think, total on the thing. So if I were you guys, I would print this out, and then if you're looking at something, and if your standard deviation is if your IV rank is above 50%, do a 1 standard deviation triangle. If it's lower, go wider. It worked on the SPX because you can collect enough. It's a lot harder when you can't collect enough, but that's kind of your guide and what you can use. All right. And as far as if you go to the next page, there's another page here, and I'll add on some other slides. But this is if you want to manage your winners. Okay, so what this study was, and this is where I put these good to cancel orders. So what this guy did was, for the last 2 years, or 87 occurrences, on every Friday he sold a 1 standard deviation triangle with 35 to 40 days to expiration. And he also did a 100-point wide iron condor, okay, on the SPX. So meaning he sold a 1 standard deviation triangle, but on the buy side he bought out the wings 100 points further out down there. Okay, and what he did was he compared to like don't manage it at all versus limiting losses to the credit received. All right, so let's say he sold something for $1. If it lost $1, he'd close it. So on a triangle, look what happened. His P&L, he made more money limiting his loss to the credit received. Here's his average win, of course, average credit. His biggest loss was a lot lower, though, when he limited his loss to credit received. Okay, and he used a max buying power of 90 grand because the SPX is pretty huge. You can do the same thing with the SPY. Okay, and here's the 100-point wide iron condor. Same thing. Look, limiting his losses credit received. If he did nothing, he made 23 grand. If he limited his loss to his credit received, he made 40 grand, over double. Okay, and of course, look at his biggest loss is a lot lower. So that's why you can put in your good to cancel order. So what that means is, let's say you sell something for $1. Okay, you put a good to cancel order, like a stop order, buying it back at $2. Meaning, because if you buy it back, if you limit your loss to $1, that means if you sold something for $1, so somebody gave you $1, and then you buy it back for $1, you're at a scratch, right? So that's why you have to make it at $2. So you're limiting your loss to the amount you received. If you collected $1, you're willing to lose $1, and that's what this study showed. Okay, so that was that game changer episode. So this is why I do that there. This little thing is what, if you're brand new, this is great because this is my little cheat sheet I used when I first started. So bullish means you're expecting something to go up. Bearish means you're expecting the stock to go down. And here's what you could do on a defined risk type of trade if you're bullish. So let's say you're bullish on let's say you're bullish on the stock market and you think the SPY will go up. See, as premium sellers, meaning you should already know that there's an advantage to selling. We only do the ones that say credit or the short spreads, right? So you have two options. You could sell a credit put spread, and here's the criteria you want to do it and just an example. Okay, if you're bearish, you would sell or do a credit call spread. So these two grid right here. Now you could do a debit call spread, but that means you have to pay someone else for this trade. And here's the criteria you want to do it. You want to do it when implied volatility or IV rank is low. You have a lower probability of success though because you're buying something. And there's examples there. So this is a chart I used to use when I just started. I cut that out and pasted so I know what I'd want to do. And one more thing that you might want to look at is on today's October 24th. Today's market measure, I already posted it over here though on their most applicable market measures called risk and capital allocation. If you want to know how much to put on a trade, this is a great market measure. So what they did was, if depending on the size of your account, how much money you should allocate to a trade. So check it out. So what they did was, if IV rank was between 0 and 24, and you have a $20,000 account, you want to allocate only 15% of your capital. If you have a $100,000 account, you want to allocate maybe 10%. You want 10% working. And if you have a $500,000 account, you want maybe 5% working. And of course, they did it when IV rank was higher. You know what percentage of your portfolio you allocate to a trade or to into the market or in a trade. All right, this is, and here's a study. Okay, they did one, how much of their allocation was allocated on a one standard deviation triangle on the first day of the month. All right, and so here was the results. Okay. Oh, where it says conservative, that was just fixed. So what that means is they just put, if you look over here, if you had a smaller account, they just invested 15%. Okay, $100,000, 10%. Okay, it didn't matter what the IV rank was. And in these columns here, they're saying, well, if IV rank was here, you allocated, 15%. Same thing. So as you can see, as IV rank gets higher, you want to have more of your money working. If IV rank is lower, you want less of your money working. Okay, and you can see, what happened. You made more money, of course, as the IV rank went higher. Just for a $20,000 portfolio. If you have more in your account, here you go. There's a table right here. You can just kind of put, and the results. Okay, percentage of wins, of course. When IV rank was 50 or more, and you allocated more of your portfolio, that's what happened. And of course, here's a $500,000 one. But these were the results. But here's the allocations, what they did. And so, of course, you scale in it. You have more of your money at work depending on what the IV rank was. And all they did was they tested it. They did it on first day of every month. They would allocate X amount of dollars. And if on that first day of the month, it was, if IV rank was 25 or higher, and you had a $20,000 account, they'd trade 35% of the portfolio. Okay, and that's it. The next month, if on the first day of the month IV rank was higher, they allocated more. And that's basically what they did. So I think you should cut out one of these, and that way I think with those three slides, if you paste those up, you'd know in a position how much time you have. You can monitor your position on basically depending on where your position is and how many days are left in the trade. You can tell if you should manage your winners or not. So this is really good for if you already have positions on. Okay, so if there's 35 days left in the trade and you've made more than 30%, or you're at 30%, especially if you're up more than 30%, take your profits. How can you tell? Well, in Dow, for example, you can see here in VXX, I'm up 22.7%. But if you look, I have 28 days left in the trade. But this is not accurate because this is not a strangle. This is not a golden gecko either. This is a straddle, so that's a different story. But anyway, that's how you can tell. You can look over here. You have 28 days left to go in the trade, and I'm up how much? I'm up 22%, let's say, right? So if it was a strangle, you'd go back and go, well, there's 28 days left, so that's right around here. I'm up only 20-something%. No, hold the trade because you're behind. Okay. So that's just a really neat tool for you to use. And the other one, of course, I use is IV rank. And when, wait, right here. I'm sorry, volatility adjusted strike. So this one right here. Oh, no, wrong one. Well, I'm just doing a real quick recap. This one right here. So you kind of know, okay, what you should trade. If IV rank is this, you should go this further out. And if you combine all three of what we just did, it makes for some real profitable trading. Hope that helps. Have a great day.